We begin with Chapter 13. In this chapter, we will analyze in detail the Long Straddle strategy. The Long Straddle position is used when the market outlook is bullish or bearish. That is, we expect a sharp move in the stock price in either direction. The strategy consists of buying an at-the-money call and an at-the-money put with the same strike price and the same expiration date. Here we can see the risk graph of the position. What we are seeing is a graph with two axes. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. It is important to mention that the graph indicates the profits and losses per share on the expiration date of the contracts, and besides, the values do not include brokerage commissions. The debit paid to initiate the position is given by the premium paid for the call plus the premium paid for the put. With this strategy, we can make profits in either direction. The maximum profit to the downside is limited, but it can be very large. The most we can make is equal to the strike price of the options minus the debit paid multiplied by the number of shares. This occurs if the stock price falls to zero. The maximum profit to the upside is unlimited because the increase in the stock price has no limit. On the other hand, the maximum loss that we are exposed to is limited. The most we can lose is equal to the debit paid multiplied by the number of shares. This strategy has two break-even points. A break-even point to the downside, called break-even point 1, and a break-even point to the upside, called break-even point 2. Break-even point 1 is equal to the strike price of the options minus the debit paid. On the other hand, break-even point 2 is equal to the strike price of the options plus the debit paid. The break-even points define the profit and loss zones. In our case, for stock prices lower than break-even point 1 or higher than break-even point 2, we are in a profitable situation. In contrast, for stock prices between break-even point 1 and break-even point 2, we are in a losing situation. The great advantage of this strategy is that the loss that we are exposed to is limited, and the profit we can make is practically unlimited in either direction. If possible, especially for beginners, it is always recommended to choose strategies that expose us to limited loss and unlimited profit. Continuing with the analysis, the initial margin required to open the position is equal to the 100% of the total debit paid. An increase in volatility helps the position. Time decay hurts the position. With respect to exit conditions, to fully close the position, we must sell the call and the put. If the stock price is lower than break-even point 1 or higher than break-even point 2, we are in a profitable situation. Otherwise, we are in a losing situation. In the case that the stock is trading at a lower price than break-even point 1, the position can be partially closed by selling only the put. Thus, we can hold the worthless call in case the movement of the stock changes. In the case the stock is trading at a higher price than break-even point 2, the position can be partially closed by selling only the call. Thus, we can hold the worthless put in case the movement of the stock changes. As we will see later in an example, this can result in a large increase in our return on investment. The Long Straddle strategy is generally used when we expect an event in the company that may cause a large move in the stock price in either direction. Remember that with this strategy, we can make profits both to the downside and to the upside. So what we expect is a strong move in the stock no matter what direction it is. The events that can cause a large move in the stock price may include the earnings reports, which are released quarterly, the release or approval of a product, a business deal, or a court judgment. In this graph, we can see the influence of time decay on the position. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. The blue curve indicates the profits and losses at trade initiation. As we get closer to options expiration, the curve of profits and losses is like the one shown in green. And finally, at options expiration, the curve of profits and losses is the one shown in red. We can see that as time passes, the gap between break-even point 1 and break-even point 2 increases. And as the gap between the break-even points increases, the range of prices for which we are in a losing situation increases. Therefore, in this case, time decay hurts the position. Now let's see what the delta of an option means. One of the most important parameters to be considered when investing in options is the one called delta. It measures the change in the price of an option, that is, the premium, relative to the price change of the underlying stock. The option's delta ranges from -1 to 1. The positive values correspond to calls and the negative values to puts. For example, if a call has a delta of 0.4, that means that for every dollar the underlying stock increases, the premium of the call will increase approximately by 40 cents. In terms of absolute values, the more in the money an option is, the higher its delta. In contrast, the more out of the money an option is, the lower its delta. The options that are at the money have a delta of approximately 0.5, that is, plus 0.5 for calls and minus 0.5 for puts. And, this is very important, the delta of an option can be interpreted as the probability of the option being in the money at expiration. For example, a call with a delta of 0.8 has an 80% probability of being in the money at expiration. On the other hand, a put with a delta of minus 0.3 has a 30% probability of being in the money at expiration. As the delta is a measure of change relative to the price change of the underlying stock, the stock itself has a fixed delta of 1. Thus, when setting up an options strategy, it is possible to determine the delta of the overall position. Bullish options strategies have positive deltas, while bearish strategies have negative deltas. Bullish strategies include buying stocks, buying calls, and selling puts. Bearish strategies include selling stocks, selling calls, and buying puts. The Long Straddle strategy consists of buying an at-the-money call and an at-the-money put. Therefore, the delta of the strategy equals 0, because the delta of an at-the-money long call is plus 0.5, and the delta of an at-the-money long put is minus 0.5. That is why the Long Straddle is part of the delta-neutral strategies, that is, strategies to be neutral on market direction. In these strategies, the volatility is more important than the direction of the underlying stock. That is, we are focused on the movement of the stock and not on its direction. Therefore, delta-neutral strategies provide investors with the ability to make profits regardless of market direction. Even several of the major financial institutions in the world use these types of strategies. It is important to mention that when investing in options, in addition to the delta, we can analyze the following parameters: gamma, theta, and vega. Gamma measures the change in the delta of an option with respect to the change in the stock price. Theta measures the change in the price of an option with respect to a change in its time to expiration. And Vega measures the change in the price of an option with respect to its change in volatility. In financial jargon, all these parameters, including the delta, are known as the Greeks. Let's see an example of how this strategy works. Here we are seeing the stock chart of the Google company. As we can see, on July 7, 2011, the company was about to report earnings in 1 week. As we said, on Thursday, July 7, 2011, Google was about to report earnings in 1 week, so we could expect a big move in the stock price. In order to take advantage of that, suppose at that time we had decided to enter a long straddle. At the close of that day, Google was trading at about $546, while the options expiring in August 2011 and with a strike price of $545 had a premium of $21 for the calls and $20 for the puts. Thus, we could have bought one call with a strike price of $545 and expiration in August 2011 at $21, and one put with the same strike price and expiration at $20. With one contract, we would be in control of 100 shares. So the long straddle would have cost us $41 per share. That is, $4,100 overall. A few days later, after the market close on July 14, the company reported earnings. As the reported earnings were higher than expected by the financial analysts, the stock opened the following day with a rise of 13%. That can be seen here. We initiated the trade on July 7, and a few days later, after the market close on July 14, the company reported earnings. As the reported earnings were higher than expected, the stock opened the following day with a rise of 13%. At that time, the premium of the call was $58 and the premium of the put was $3. If we had closed the position at that time by selling the options at those values, we would have received a credit of $61, so our profit would have been $20 per share, because we had placed the trade at a debit of $41 per share. Thus, we would have had a total profit of $2,000, making a 49% return on investment in only 8 days. That is, we made $2,000 by investing $4,100. If we had sold only the call, we would have made a 41% return on investment as we had sold at $58, making a profit of $17 per share. That is, we made $1,700 by investing $4,100. So we would be holding the put in case the movement of the stock changes. Of course, by not selling the put, our return is a little lower. But if later the movement of the stock changes, that may result in a large increase in the return on our investment. Later, on expiration Friday, August 19, the stock closed at $491. That can be seen here. After reporting earnings, the stock continued to rise for a few days, but then started to fall until it closed at $491 on the expiration date of the options. At that time, the put expired in the money, so if we had held it, we would have made an additional profit of $54 per share, as the strike price was $545 and the stock price was $491. Thus, we would have had a total additional profit of $5,400. Therefore, as we had made $1,700 with the call, our total profit would have been $7,100, making a 173% return on investment in only 43 days. That is, we made $7,100 by investing $4,100. Remember, this would have happened if we had sold only the call and we had held the put to expiration in case the movement of the stock had changed. In effect, that happened, so we would have finally made a profit of $7,100. Here, we can see the numbers of our example. The strategy consisted of buying one Google call with a strike price of $545 and expiration in August 2011 at $21, and one put with the same strike price and expiration at $20. The debit paid is equal to the call premium plus the put premium, in our case, 21 plus 20, which is equal to $41. Therefore, our investment is equal to 41 multiplied by 100, which is the cost of the strategy per contract, multiplied by 1, which is the number of contracts. That's a total of $4,100. This money is debited from our account. The initial margin required is equal to the 100% of the total debit paid, that is, $4,100. This is the minimum amount of money that must be deposited into our account in order to open the position. The maximum profit to the downside is equal to the strike price of the options minus the debit paid multiplied by the number of shares. That is $50,400. This occurs if the stock price falls to zero. The maximum profit to the upside is unlimited because the increase in the stock price has no limit. If we had sold the call at 58 and the put at 3, we would have made a profit of $2,000. On the other hand, the maximum loss that we are exposed to is equal to $4,100. That is, the total debit paid. And regarding the break-even points, break-even point 1 is equal to the strike price of the options minus the debit paid. In our case, 545 minus 41, which is equal to $504. On the other hand, break-even point 2 is equal to the strike price of the options plus the debit paid. In our case, 545 plus 41, which is equal to $586. Here we can see the order we must enter to open the position. It is in order with two legs. Leg number 1 corresponds to the long call and consists of buying one Google call with a strike price of $445 and expiration in August 2011. Leg number 2 corresponds to the long put and consists of buying one put with the same strike price and expiration date. The entered price is given by the sum of the purchase prices of the call and the put. In this case, 21 plus 20, which is equal to $41. This is the money expressed per share that will be debited from our account when the order is filled. On the other hand, here is an example of the order we must enter to close the position. It is an order with two legs. Leg number 1 consists of selling the call we had bought. Leg number 2 consists of selling the put we had bought. The entered price is given by the sum of the selling prices of the call and the put. In this case, 58 plus 3, which is equal to $61. This is the money expressed per share that will be credited to our account when the order is filled. Before finishing this chapter, we will see what is known as long synthetic straddle. A long straddle can also be simulated by combining stock shares and options. In that case, the long straddle is called long synthetic straddle. If put options are used, the strategy is implemented by buying the stock, that is, by taking a long stock position, and buying at-the-money put options, that is, by taking a long put position. In this way, we must balance both sides of the trade so the overall delta of the combined position equals 0. Remember that the stock itself has a fixed delta of +1. So if we buy 100 shares of a company, this position will have a delta of +100. On the other hand, as the put options are at the money, they have a delta of approximately minus 0.5 per share, or minus 50 per contract, as each contract represents 100 shares. Therefore, if we buy 100 shares, which have a delta of +100, we must buy 2 at-the-money puts for the strategy to be delta neutral. The 2 at-the-money puts have a delta of minus 100, that is, minus 0.5 multiplied by 200, as we are buying 2 contracts. In general, the word synthetic is used to call any financial instrument created artificially to simulate the behavior of another financial asset. If the long straddle is simulated using put options, when the stock price increases, the long stock position becomes profitable. On the other hand, when the stock price decreases, the long stock position loses money. But we will make a profit on the long put position because one put protects our long stock position and the other one makes money. Remember that for each 100 shares, there are 2 puts. In contrast, if call options are used, the long synthetic straddle is implemented by selling the stock, that is, by taking a short stock position, and buying at-the-money call options, that is, by taking a long call position. In that case, we must sell 100 shares and buy 2 at-the-money calls for the strategy to be delta neutral. Thus, the 100 shares sold, which have a delta of minus 100, are offset by the 2 at-the-money calls purchased, which have a delta of plus 100, that is, plus 0.5 multiplied by 200, as we are buying 2 contracts. The advantage of the long synthetic straddle is that the stock side has no expiration date. However, as it has a higher cost of entry, the long synthetic straddle is always less profitable than the long straddle totally set up with options. Here we ended with the chapter Long Straddle. In the next chapter, number 14, we will analyze in detail the short straddle strategy.